Next is investment principle diversification. Diversification suggests that a portfolio of different kinds of investments on average may potentially yield a higher return and pose less risk than an individual investment. In short, diversification helps you manage the company's specific risk we illustrated on the previous image. Let's assume we have an investor who has $750,000 to invest. On the left is a hypothetical example of $750,000 placed into a single investment. On the right is a hypothetical example of the same amount divided between 3 investments. Remember, diversification is an approach to help manage the investment risk. It does not eliminate the risk of loss if a security price declines. After 20 years, the single investment, assuming a 5% return, will have grown to roughly $2 million. During the same period, our diversified portfolio will have grown to just over $2 million. And in this example, we're assuming that one of the investments was a total loss. That is, it was worth nothing at the end of the 20 years. There is more to diversification than simply spreading your money around to different investments. In principle, you want to select investments that have low correlation with each other. That is, investments that don't tend to behave the same in a market environment. One measure of correlation is called the beta. Beta is a measure of stock's correlation with the overall stock market. Beta is a measure of how likely a stock is to move up and down as the overall stock market moves up and down as well. In this example, we're using the S&P 500 Composite Index Total Return to represent the market. So it has a beta of 1. The S&P 500 is an unmanaged index that is generally considered representative of the U.S. stock market. Keep in mind, index performance is not indicative of the past performance of a particular investment. Individuals cannot invest directly in an index. A stock price that varies more widely than the S&P 500 would be expected to have a beta that is greater than 1. A stock with a beta of 2, for example, will rise and fall, on average by twice as much as the wider stock market. So if the S&P 500 falls by a hypothetical 1%, a stock with a beta of 2 would be expected to drop by 2%. Beta can also be negative. For example, a stock with a beta of -1 would be expected to see its value fall by 1% when the market rises by 1%. Another investing principle is the consideration of taxes and inflation. This chart shows how many days the average American will work in 2018 to pay their tax obligation. Americans pay income taxes, Social Security taxes, sales and excise taxes, and property taxes. The same concept occurs when you put your money to work. Taxes may take part of your return. So when you're looking at the return of an investment, ask yourself, what is my return after taxes? Another silent thief you have to watch out for is the effect of rising prices, otherwise known as inflation. Over the long term, inflation erodes the purchasing power of your income and wealth. It is easy to see. Just look around from 1967. In 1967, new house cost was about $14,250. Income was about $7,300 per year. A gallon of gas cost about 33 cents. And the average cost of a new car was about $2,750. In 2017, the average price of a new home was just under $403,000. The median household income was just over $61,000 per year. The average prices for a gallon of gas was $2.42, and the average price of a new car was $36,000, just over that. Our last investment principle is get started now. Procrastination can be costly. For example, if you were to deposit $250,000 in an account earning 6%, at the end of 20 years, your account would have been worth just over $800,000. If you waited 5 years before starting your investment program, the $250,000 would have 15 years to work and would have grown to just under $600,000. And if you waited 10 years and then started your program, you'd only end up with almost $447,000. To put it another way, waiting 10 years to start was a $350,000 decision. Keep in mind, this is a hypothetical example used for illustration purposes only. It is not representative of any specific investment or a combination of investments. When you're ready to move forward, we identified some specific action items to help you get started. First, put together a personal income statement. You want to identify all of your sources of income and where your money is going. Next, put together a simple balance sheet. This should give you a good snapshot of your assets and liabilities. Identify your long-term, medium-term, and short-term financial goals. Then be honest with yourself about your tolerance for risk. Can you stomach big market swings, or are you more comfortable with less volatility? Once you've sized up your personal finances, it may be beneficial for you to talk to us and review if your risk tolerance matches your portfolio. Our contact information is on the screen and in the description. So let's review the 5 smart investing principles. First, estimate your time horizon. Is your investment horizon 3 years or 30 years? Second, know your risk profile. Can you tolerate big swings in the value of your investments? Or do you prefer less volatility? Knowing your risk profile is an important step as you consider various types of investments. Third, diversify, diversify, diversify. This is so important that we listed it 3 times. Fourth, consider the effect of taxes and inflation. And finally, get started now. Take the initiative and get going. If you learn nothing else today, please understand the importance of getting started now. When it comes to pursuing investment goals, the more time you have, the better. Again, keep in mind that diversified portfolios does not assure a profit or protect against loss in a declining market. Following a few smart investment principles can make your investment efforts much more effective. But it doesn't end there. Effective investing requires an ongoing effort, and there's a lot more to know. Here are some questions that arise at different stages of life. Anthony and Selena have a growing family and wonder, what's the best way to fund our children's college education? Dave and Christine are in retirement. They ask, should we change the allocation of the portfolio now that we're no longer working? Rebecca is a single woman with a small business. She wants to know, my business is finally doing well. What is the best way to put my extra income to work for my family's future? Isaac likes to do research online. He asks, does it make sense to watch the markets every day and trade on what happens there? Answers will depend on each unique situation. There are a number of strategies you can use to attempt to invest wisely. And that's where we come in. We specialize in helping people just like you set up investment strategies that help them pursue their investment objectives. If you're ready to take a fresh look at your investment portfolio, feel free to contact us. To help you learn more about investing, I have a webinar on investment strategies for volatile and uncertain markets. The webinar link is in the description. Your plans for the future shouldn't be dependent on daily fluctuations in the stock market. Gains and losses are part of investing. By using a deliberate, time-tested approaches, you may be able to pursue your goals without feeling as though you need to constantly adjust your portfolio to react to today's news. Again, the webinar link is at the bottom. Click on it, and we'll see you there.